Good morning and welcome to the Saxo Bank Morning Call. It's Thursday, October 4th, and did we ever have market action yesterday, especially in the U.S. bond market? U.S. Treasuries lifting all across the curve in a big bear steepening move. That means the long end of the curve lifting even more aggressively. I've got a chart here showing the 30-year. This is a big development. This is the first 4+ year high in the U.S. 30-year, the longest end of the curve, since the early 1980s. So we're talking about the first time in over a generation we're seeing a multi-year high of this degree in the U.S. bond market. What is driving the action? We saw the ISM non-manufacturing survey coming in at the highest, almost the highest in its record, which started in the late 90s. There was one data point back then that saw a record high, the record high, but this is the highest number at 61 plus for the cycle. And then as well, the Fed Chairman Powell out speaking, and a lot of offhand comments in that speech or after that speech, in which he's talking about the rates not being even close to neutral yet. This had the market spooked as well. But I think the interesting thing being in the market action, just an avalanche of selling in the bond market. There wasn't just a one-off move. It felt like there was a lot of flow going through. This has tremendous implications across markets. We saw risk aversion picking up a little bit, risk appetite weakening to a degree, but I'm actually surprised at how little this is fed into the general mood and risk. The dollar, however, getting a pretty solid boost. And Mathias, you sit with options, FX options. Not really much of a pickup in volatility, although I think this is quite a big event.
No, it's not really. I mean, we see a little bit higher volatility because of the break of 115 in euro dollar.
Yeah.
But it's just marginally higher. So 1 month in euro dollar, for example, is up 0.4 today. So it's definitely not any panic.
And your chart here shows this broad Deutsche Bank FX volatility index, the black on top being the 1 month, the blue being the 3 month volatility. I mean, we're not even at the highest from the summer, so it's not like the market is really sitting up and taking notice just yet.
As you can see, I mean, the black line on the chart is the 1 month implied volatility, while the blue one is the realized volatility. So we see that
the realized versus the
So we see that the implied volatility has been trading here in quite narrow range over the last couple of months. We're sitting on the high if you look at the last 3 months. But if you look at the blue line, spot hasn't really moved, so the realized volatility is declining quite a bit over the last months. So the market in general is trading with quite a high risk premium.
Right. Well, I think it's justified, I would say, if we're going to see a big move here in U.S. yields.
Yeah.
Okay, and your suggestion is that the dollar yen looks the most overvalued relative to the actual moves in the market.
Yeah,
in other words, the real has been quite sluggish relative to what people are trading in the options.
Yeah, so if you go back to the chart again and look to the chart to the right, just showing the risk premium, I mean the difference between the implied volatility and the realized, and dollar yen is currently the most overvalued. So we've seen dollar yen slowly grinding higher over the last months and just doing small steps while the implied volatility hasn't really moved.
Yeah, so. And on that point, with the Japanese yen, we're looking at a situation where we've talked about the risk of sort of explosive action in yen crosses if yields continue to rise. And we're seeing the gauntlet being laid down here by the bond market and challenging the Bank of Japan's yield curve control policy. We have U.S. yields unleashed. The Bank of Japan controlling yields from the 2-year out to the 10-year. And the interesting thing being that there's this supposed cap around 15 basis points in the JGBs, and we're seeing that challenged at this moment. We're seeing 16 basis points trading this morning, up from a previous high of 14 basis points. Is the Bank of Japan going to have to let this slip? And if we see the Bank of Japan letting it slip, and it doesn't control the longer end where yields are aggressively going higher in Japan, 20, 30 years, etc. If we don't see the Bank of Japan enforcing this cap, and we start to see risk off because the long-term price of global money in the U.S. dollars is going higher, I think we have this sudden introduction of yen volatility. And we have a chart here. Actually, I'm going to try to go to our Saxo Trader where we have euro yen. Maybe not across people look at much. If we go to the screen, we have euro yen here trading back towards 131, and that is towards the 200-day moving average. To me, that's not so interesting. It's a local pivot point. It's quite interesting on the local pivot point basis, but more the scenario that develops from here if we have continued EU existential risk, the sudden introduction of yen volatility on the idea that the Bank of Japan is going to have to fold on its policy. I think euro yen could be an interesting combination on top of the sort of traditional classic risk-off trades like Aussie yen and that stripe of yen crossings. But Mathias, you're not necessarily seeing big moves in or aggressive moves in the market to reprice yen calls or anything?
Not at the moment, no. So look at the risk reversals. It's been trading fairly flat over the last couple of months, and we don't see much. I mean, it's
so the premium for puts is not that remarkable.
No, premium of puts is actually at the lowest level now because the spot has been trading higher and higher. So the risk reversal is coming in a little bit. So buying puts at the moment is
so people that want to take that take that position for yen calls is a bit cheaper than one would normally expect.
Yeah, then you should definitely start to look at it now.
Okay, great. So we also have a euro dollar. We just want to flash the chart here. This is just a static chart on euro dollar, reminding people 115 is a very big level in euro dollar. We traded there, close to there back over the summer, early part of the summer. Then we dipped below and a really quick retracement back above. Seemed to be a rejection of the idea that we're going below 115. And now we're seeing, we're seeing the action taking us back below. I think if we don't immediately reject this break and kind of head back higher, I think the risk is we go on to test that 113 area and possibly even a bit beyond there, especially driven by, of course, the U.S. Yields, U.S. bond market. I would suspect the EU tries to play catch up to a degree on the yield front, but I wasn't expecting this aggressive a move from the U.S. Treasury market, and that is the case. I think the risk is of more dollar strength in the near term. But let's stay posted around there, around that 115 level. And Mathias, you also brought a chart of the euro dollar. The thing you wanted to point out was that even though we're seeing a pretty aggressive move in spot here, the premiums or the 1 month volatility hasn't even picked up to the highs from August or early in the summer.
No, we've gradually been trading higher now with spot coming down from 118 down to 115. And as I said on the break today of 115, spot the volatility is up 0.4. Notable is also that of this 0.4 vol higher today, 0.2 of a quarter comes from the 1 month roll that's now been rolling over to the midterm election.
Right.
So
key point there. Yeah. How the market takes the midterm election in the U.S. November 6th. And then we look at as well cable. This is a volatility chart that Mathias has provided here. On the top you see the 3 month volatility, and then you see the risk reversal down lower, showing a tremendous premium here, getting priced into sterling puts versus the dollar. So a lot more interest here in trying to gain what is going to happen with the Brexit outcome.
Definitely. I mean, we see that on the top part of the chart, I mean, volatility has been going higher quite a lot over the last 2-3 months. And risk reversals are now down to 2% for puts. So the premium for hedging of a no deal Brexit is the highest we've seen now for.
And then as you go into lower and lower delta puts, the implied gets even higher and higher. So some people might consider something like a bear spread strategy to take advantage of the richness of those low delta puts.
Yeah, definitely. I mean, if you think that we will get not the complete collapse of sterling, I mean, put spreads, for example, is
I remember we looked at spreads like that over the Brexit event. I wrote a piece then where we talked about, assuming that the end of the world is not nigh for sterling, that at some point there is a floor, then some of these strategies provided quite good risk to reward on a bear spread strategy. So consider that for an options trade. And then finally today, let's round out with the calendar. I think the calendar items not terribly interesting today. That average hourly earnings number on Friday picking up some added interest because, of course, does it support this latest meltdown in the U.S. bond market and higher U.S. yields? If it does so, I think we have a continued risk of volatility across asset classes. Do note one point of interest with EM very much under pressure from a move like this in the U.S. dollar and U.S. yields. We have a Mexican central bank decision up tonight. And I think the Mexican peso and other emerging market currencies could very well be under pressure if the dollar remains strong here. And then again, tomorrow I think that the U.S. data taking on a bit of added importance because of what has just unfolded yesterday in the U.S. bond market. That's a wrap for today. We'll be back tomorrow with the Saxo Bank Morning Call. Thanks.